Hello, I'm Adam Grimes, and welcome to Module 3, Unit 4 of the Art and Science of Trading. We're going to be looking at patterns between trends and ranges and all of the complications that can start in those transitions. So these are important areas. Some of the best opportunities come at these points where trends become ranges or vice versa. As we've seen in some of the previous units, these definitions can be a little bit slippery. So you and I, just very simply, we might look at a chart differently. We might define swings differently. We might have some discussion about whether a market's in an uptrend, downtrend, or in a range. Many times it's possible to read a chart many different ways. Even if we had perfect definitions, even if there was only one correct way to define these things, which is not true, but even if that were true, there are still many cross currents, a lot of noise, and plenty of opportunities for confusion. So what are these transitions? Well, let's try to narrow it down to a handful of patterns, and we'll dig into some of those. This is a very deep and complex topic. I'm not going to spend a lot of time here, but in a fairly short period of time, we're going to go pretty deep. So the first pattern we need to think about is a breakout. And in a breakout, we have a market in a range, and then it breaks out above. Or conversely, we have a market in a range, and it breaks out below. Now, some traders, you do need to be aware there's a terminology issue here. Some traders will call this a breakout and this a breakdown. You will see that language, and particularly if you're not a native English speaker, you may notice this. If you are a native English speaker, you probably heard this all your life. What I have noticed is that stock traders tend to be a little bit more clear about this. Currency traders and FX traders and futures traders will tend to call these both breakouts of a range without focusing too much on breakout or breakdown. Same thing. And in fact, in my speaking, you're going to notice I will say breakout, and sometimes I mean down. The other possibility is we have a trend that ends into a trading range. So you have a trending market that stops trending into a range. Now, we've seen this in different contexts already. Another possibility is we have a trending market that all of a sudden starts trending in the other direction. And, of course, it's possible to have failures. So you could have a breakout fail. You could have a trend going into a trading range, and that fails and the trend continues. Lots of possibilities. And this is one place that a lot of people get sidetracked. If you start trying to catalog, we have three very simple categories here. A trend can become a range, so the trend turns into a range. A trend can become an opposite trend, or a range can become a trend. This is pretty much the only thing that can happen from a very low level, but once you start trying to catalog the nuances and all the failures, and I've even seen I saw a book where a guy talked about a failure of a failure of a failure. And I think at that point, maybe we have enough layers that is not useful. So I would encourage you, those complications and let's say, rather than just saying complications, let's say those precise definitions are there when and if you want them. But I think if we focus on high-level stuff, that's probably good for our work. So breakouts. Now, just take a look at this chart before I mark on it, and let me talk about breakouts, and then I'll show you several ways to see breakouts. So whenever we have a trend emerging out of a range, this always happens through a breakout. Range is defined by, let's just think about some other definitions. A range is defined by support and resistance holding, and one of the definitions of a trend I gave you was that trend is price action that breaks support and resistance fairly consistently. So when that support and resistance in the range starts to break, the market starts to trend. It's almost a tautology, right? It's maybe not such a useful definition, but just remember that every place that a trend emerges out of a range, another way to say the same thing is a range becomes a trend, it happens through a breakout. Let's highlight some ranges here. So here's a range, and so this is a breakout of the range. The market goes up here, and we find we've defined some type of range, and we have a breakout or you break down. Now, you do have some issues. Is this a range? I don't know. Perhaps it is on a shorter time frame. I would consider it to be. If you would tell me it's not, I think you could make a valid case for that. We also have some type of range here. And so what we're doing, on one hand, there's nothing new here. I've shown you several times how to draw these ranges, how to think about the ranges, but now we're focusing on these transitions in the breakout. One of the things that we can look for are patterns that come before the breakouts. And if we have a resistance level here, a couple powerful patterns. Let me try that again. If we have a resistance level here, a resistance level that holds, a powerful pattern is to see a series of higher lows into that resistance. And if you just think chart story format about what's probably going on here, you have people that are looking to buy as the market declines, and the fact these buyers are willing to step in at higher prices at least suggests that there's some buying conviction here. Another possibility is if we have a resistance level here, if we see this very tight consolidation above the resistance, well, what's going on? In both of these cases, this is a failure of price rejection. You should start to see how all these things connect. And very early on, I gave you a kind of academic definition of price rejection, but now we're very, very close to applying it. And here, when you see the failure of price rejection, that gives us an edge to both the likelihood that there's going to be an impending breakout and also may say something about the quality of that breakout. Because once the breakout happens, what I've just drawn is what we think might happen, but it could also be something like this, right? So when the breakout happens, how good is it going to be? Another possible variation here is what people call a cup and a handle formation, and that usually looks something like this, and you'll see it's what I've drawn already, right? It's all these things we have several things here that actually turn out to kind of be the same thing. What we are seeing is a failure of price rejection. Price is holding out near the level, and this acceptance suggests to us the level will break. What are some other things to think about? Well, when we do have the breakout, we want to be aware of what happens at this breakout level. We want to see some activity. We want to see probably some volume. You want to see ranges. You basically don't want to see that it breaks out and doesn't go anywhere, because then what we've probably done, this, is we've just expanded the range, right? And the difference between expanding the range and a breakout is going to be that you see good activity at the breakout level. What happens following the breakout? Well, of course, we don't want to see an immediate failure, but we also do want to see that you have your breakout level, and you'd like to start to see some pullbacks. We haven't used that word much, but you want to see the market is basically able to hold above the level. It doesn't have to happen, though. And this is one of the oversimplifications I think people make in technical work. A lot of times there'll be a breakout and they say the breakout level has to hold. It does not have to hold. And, you'll see that in your own work here. Some of the other things that we see, this is a good example of this type of consolidation beyond the level. This is kind of the idealized thing. You have this breakout, and this was preceded by a tight range before the breakout, and then you have a level you have a smaller range that's holding above the previous breakout level. So the previous resistance level. This is kind of a best case scenario, but just be aware that it certainly is possible that you may see the range down here. You may see the activity down here. This level is not as important, I believe, as some people think it is. And so the other thing we need to consider is when a trend becomes a range. And as we have done in previous units, let me just outline some swings with, again, the caveat that you may wish to outline them in different ways. And so this is a trending pattern, right? We have a fairly consistent pattern of lower lows and lower highs. And then what happens here? Well, we're in some kind of range. So how exactly does that happen? You have a trend extreme, and we think of this as potential support. So the market is not able to come back to that support. We look at this area where the market reacts, and this is your first confine of the range. And then we talk about this range expanding. What do you have here? An eventual breakout. And, keep in mind, not every trade is just, this could very well be a successful breakout trade. Could also be a failure depending how you catalog it, but it is at least an intended breakout. However, our focus here and in some of the work in the homework is going to be what happens when the market transitions into this range. There's also an example over here where we have, you have this pre-existing trending pattern, and then we have a high, and then we set up some type of support, and we're in a range here. And again, look, little consolidation against the level before the breakout. We probably don't really have that here, but this, and then come back and test the breakout level. I don't think it's quite as exact as I've made it look there, but conceptually that's what we're looking for. So what are some indications that we have a trend becoming a range? Basically what we see is support and resistance starts to hold. Momentum starts to fail. It's kind of saying the same thing. Two typical markers to watch for is a failure test, and that's a term you're going to know later, but basically it is you have a trend and the market tries to go above, but then can't go above. Fails, basically. The other possibility is strong counter trend momentum. So when you have this type of move, which again, if you're comparing the swings to the previous downswing, when you have a previous downswing that is bigger than other downswings, that is a warning that something is changing in the trend pattern. Trend to opposite trend. So here's an example of this. We have an uptrending market here, goes into a small range, and then look, very sharp counter trend momentum. Let me get those marks out of there just to highlight this. Look at the magnitude of this compared to any previous downswing. And remember, we don't really need to go back into this area because these types of comparisons are most valid locally. So if I'm comparing January to July or August on a daily chart, that's not as useful as comparing November and December to January. So you do probably want to carry these locally, but even if you were to go back and compare here, you would find some similar downswings, but the market was in a very different environment. And what we're looking at, so I guess another reason that's inconsistent or doesn't make sense is we're looking to understand the dynamics in this uptrend. We're looking to understand this, asking the question, is this swing consistent with the uptrend? What good does it do us to go back and look at an area where the market was not uptrending? So there's one example. Here's another example, which I think is a little bit more clear even, that you have some type of uptrend and then a fairly immediate breakdown, perhaps without a lot of warning. Keep in mind that it's human nature to always look for these trend reversals, and much of the commentary you hear, not in social media, but not just in social media, in major media, is people looking for trend reversals. Why? Well, I think there's an asymmetrical payoff. And what I mean is that I can be the guy who says for 10 years, stocks are going to crash. It's the end of the world. There's a coming financial apocalypse. The end of the financial world. Stocks are going to crash. Protect your portfolio. You're going to lose everything. And there are people who do that. There are people who said that for 20 years. If you had followed their trading signals, you would have literally lost all of your money. But they're still experts. Why? Because every time the market goes down 10%, they're proven right. Quote, right. I hope you hear the words right. Now, from a trader's perspective, from an investor's perspective, from people who actually work in the market, actually trading is a lot harder. And you don't have the luxury of just saying nonsensical stuff like, one of the classic categories of people, if you want to do a little bit of research, are the perma bears. These are people who, no matter what the market does, they're always bearish. Yet, they will be put on television as experts, and nobody dares to say how, you were wrong for 500% for 25 years. That's not really what the media is about. And this is what I mean by asymmetrical payoff. You can also be the guy who correctly says stocks are going up, up, up. And as soon as stocks go down even a little bit, people feel those losses very passionately and they get angry. So from a commentator's perspective, if you're selling newsletters to a gullible public, this is smart. It's smart to be a perma-bear. Now, it's bad. I think it's immoral, basically. It's not intelligent from a actual investor standpoint, but from a marketing perspective, that's giving people what they want. What they need, though, is a perspective to actually understand how these markets work. And also be aware, the problem with looking for reversals is that many trends end simply into a range. So you can be calling for the end of a trend and it just goes into a range. And you were right, the trend ended, but if you've been short, you wouldn't have made money. Same thing with looking at a declining market. It may just stop going down and it may tie up your capital for a long time before the trend actually reverses. So how do you think about this from a practical perspective? I think the most important thing, and we're going to talk about this plenty later in the course, but just for you to think about in context of the homework for this module, you want to have a reason. So, and there are good reasons and bad reasons. Bad reasons would be, I think it's gone long enough. And that's kind of how a lot of people work. They'll look at trends and, big picture trends and they'll say, oh, I can't believe it's gone this far. I don't think it can go any farther. That's not really a good reason because a lot of times trends can go much, much, much longer than anybody would imagine possible. So you need a good reason. What's a good reason? Well, we've talked about some of these things. You already know things. You've learned more than you might realize. Just a parabolic exhaustion of some kind, other end of trend patterns, sign the market is rolling over, strong momentum against. You know this stuff. So good reasons are these simple patterns that you have learned. Bad reasons, well, there are a lot of bad reasons. So just a few words here on failures, more than a couple. It's always possible to frame something out as a failure of something else. Trend goes into a range. What's a failure of the trend to continue, right? Then that range breaks out higher. Well, this is a failure of the range to hold. It could also be a failure of the trend reversal. If the trend reversal is a failure of the trend, this move right here could be a failure of the failure of the failure. So you see, this can get a little bit silly. A few years ago, there was really a focus on this. The idea of trading failed patterns, trap traders. People realized this was not all of the answers all the answers people wanted did not lie in this area. It's just a way to look at patterns. It's a way that you might find useful. And if you do find it useful, feel free to use it. But I think focusing on understanding the patterns rather than trying to get too cute with the failures is probably the best thing to do. Remember, we're only playing the odds. We're only playing statistics here. And even in the best cases, our patterns will quite frequently fail just because that's the way the market works. Why? Because financial markets are highly competitive. Because there's no free lunch. A lot of smart people looking for ways to make money. And because of that, markets typically often move very randomly. So that's all we have for this unit. I'll see you back for the next unit. Thank you.